For the first, the business nature of 7-Eleven and Mr.Diy. 7-Eleven is a 24 hours convenience store selling snacks, drinks, and daily items. It's easy to find near LRT station or busy areas, perfect for urgent needs. Mr.Diy sells affordable home and lifestyle products like tools, kitchenware, and stationery. Their stores are usually in mall and focus on low price and variety. In short, 7-Eleven offers speed and convenience, while Mr.Diy offers value and choices.
Good day, madam. My name is Liew. In 2023, the company showed strong liquidity with the current ratio rising to 1.16 and the quick ratio to 0.84. However, both declined in 2024, suggesting tighter short-term financial health. The debt ratio dropped significantly in 2023 to 0.31, then increased again to 0.x6 in 2024, indicating higher leverage. The time interest earned ratio improved sharply in 2024, reaching 70.30, showing strong ability to meet interest payment. On the efficiency side, both inventory turnover and fixed asset turnover have declined over the years, which may point to less effective use of resources. Profitability remains strong in terms of gross profit margin, stay above 30% in 2023 and 2024. However, net profit margin and return on equity saw a drop in 2024, signaling a decline in overall profitability and return to shareholder.
My name is Chin, and today I would like to present the financial ratio analysis of Mr.Diy from 2022 to 2024. Starting with liquidity ratio, both the current ratio and quick ratio increased steadily over the 3 years. This means Mr.Diy became better at paying its short-term debts. Even without selling its inventory, the company has strong financial support. The average collection period decreased to just 9 days in 2023, showing that customer pays faster. In 2024, it increased again to 12 days. Account receivable turnover also reached its highest point in 2023, which support this trend. Meanwhile, inventory turnover gradually increased, showing more efficient stock management. Moving to capital structure, the debt ratio went down from 0.57 in 2022 to 0.49 in 2024. This shows the company is using less borrowed money to run its business. Although time interest earned decreased a bit in 2024, the company still had enough profit to cover interest payment. Next, under asset management efficiency, the total asset turnover remains stable across the 3 years, meaning the company used its asset consistently to generate sales. The fixed assets turnover decreased in 2023, but increased again in 2024, possibly due to better use of new equipment. Finally, looking at profitability ratios, the gross profit margin improved every year, showing better cost control. The operating profit margin and net profit margin decreased in 2024, but both remain strong. The operating return on asset stayed above 21%, meaning the company used its asset effectively. However, the return on equity dropped from 33% to 29%, meaning shareholders earn slightly less. In conclusion, the company may want to focus more on improving asset uses and shareholder returns in the future.
Next, here is comparisons between 7-Eleven and Mr.Diy from year 2022 to 2024. Mr.Diy current ratio rose to 2.3x, 7-Eleven fell to 0.88. Quick ratios, Mr.Diy 0.68, higher than 7-Eleven 0.66. Collections, Mr.Diy's 12 days, 7-Eleven 29 days. Receivable turnover, Mr.Diy 31, 7-Eleven only 12. Inventory, Mr.Diy up to 2.33, 7-Eleven down to 1.92. Overall, Mr.Diy wins in all liquidity areas. Next, from debt ratios, Mr.Diy down to 0.49, 7-Eleven up to 0.86. Interest cover, Mr.Diy stables, 10 plus 7-Eleven travels to 1.42. Asset turnover, Mr.Diy 1.22, higher than 7-Eleven 1.1.
9. Fixed assets Mr.Diy 5.28 7 fell to 5.15. Overall, Mr.Diy is more stable and efficient. For profitability ratios, its gross and operation profit margins are much higher and more stable. For example, gross profit rose to 45.85%, while 7-Eleven stay around 30%. Mr.Diy also shows stronger net profits, RA, and consistent ROE, unlike 7-Eleven, which fluctuations a lot. In short, Mr.Diy is clearly more profitable and stable.
I will present recommendations for 7-Eleven company. For the first one, liquidity ratios. 7-Eleven need to improve how it manages its cash and short-term assets. We suggest cutting down on unnecessary stocks, managing cash flow better, and working with suppliers to get better payment terms. This will help the company stay financially stable and avoid cash problem. Second, receivable and inventory management. In 2024, customer took longer to pay and stock turnover slowed down. To fix this, 7-Eleven should tighten credit rules, send payment reminders, and give discounts for early payments. At the same time, it should avoid overstocking by using better demand forecasting and only ordering what is needed. Number 3. Capital structure ratio. 7-Eleven relies too much on debt. To reduce this risk, the company should pay off high interest loans and switch to longer term loans with low interest. They also should plan their financings better and avoid borrowing unless necessary. 4. Assets management efficiency ratio. To improve how assets are used, 7-Eleven should look at underperforming store or assets and either fix, relocate, or sell them. Before spending on new items, the company should do a proper return on investment check. Also, using digital tools like online sales and delivery platforms can help them get more value from their existing asset. 5. Profitability ratios. Even though sales stay strong, profit dropped in 2024. To improve this, 7-Eleven should cut unnecessary costs, push higher margin products like their own brand items, and improve pricings. Keeping expenses low and sales high will help boost profit again.
My name is Ng Kai Sing and I would like to present the recommendation for Mr.Diy to improve their operation. Mr.Diy ability to pay short-term bills has improved, but the company should not keep too much cash or stock. To do better, it can manage inventory cash more carefully and collect money faster from customers and invest extra money in things that are easy to turn into cash. Receivable and inventory are stable, but there's room to improve. The company can make its credit rules stricter, send automatic payment reminders, and give more small discounts for early payments. It can also use smart tools to manage stock, like adjusting stock for each store and using just-in-time method. Mr.Diy is borrowing less money now, but it should still balance between using its own money and taking loans. It can try to get better loan deals and use its profit to grow the business. Also, it should avoid selling too many new shares so current investors are protected. The company is using its asset quite well, but there's still room to improve. It should check if any space, equipment, or store are not being used properly and fix or remove them. Using more technology and renting instead of buying everything can also help. Mr.Diy has good profit margins, but net profit dropped in 2023 before getting better again. Also, return on equity has gone down slowly. To improve this, the company should manage costs, sell more high-profit items, grow online and in new places, and give value back to investors through dividends or share buybacks.
Hi, I'm Kok Lian. Let's break into advice company on the sources of fund. We make a comparison between 7-Eleven and Mr.Diy. For 7-Eleven, we recommended non-debt funding, sales and leaseback unlock capital fast, joint ventures reduce financial load, and equity fundings avoid risky interest payment. While for DIY, Mr.Diy, strong financials open multiple affordable financing options. Corporate bond can drive physical expansion, while internal funds and green loans support innovation and ESG goals. In conclusion, the choice of funding must reflect each company's financial strength. 7-Eleven should prioritize liquidity and stabilize operation before expanding. Mr.Diy, on the other hand, can fund growth confidently through a balanced mix of bonds, reinvestment, and ESG-friendly finance. That's all. Thank you.